How do you like it if a professional investor with decades of experience came to you and said, you give me your money and I'll invest it in a portfolio of good stocks and I'll take a fee of just 1.5 to 2% a year. Would you like to give him the money? That's exactly what a mutual fund is. In the previous episode, we saw why investing in stocks to get rich is not everybody's cup of tea. To do this, you need finance skills, you need to study companies and markets, and it requires a lot of time and effort. Not possible if you have a full-time job. This is why mutual funds are a shortcut to wealth creation. But you may ask me, are mutual funds risky investments? Mutual funds are subject to market risks. That's a disclaimer you've seen so often, right? Yes, mutual funds are risky and sometimes you can lose your capital or make low returns from them. This is because mutual funds are a vehicle that take your money and plow them into assets like stocks, bonds, gold, etc., which may move up and down with markets. So, your returns from mutual funds depend wholly on how the markets behave. There are some unique advantages to mutual funds too. When you invest in an LIC policy, do you know where your money is going? Do you know what LIC is doing with your money? Obviously not. But when you invest in mutual funds, you know exactly where the fund manager is investing your money. He may invest in a portfolio of stocks, bonds, gold or other assets, but according to SEBI's rules, the mutual fund is supposed to declare its portfolio publicly at the end of every month. So, with mutual funds, you know exactly where your money is being invested. That is not all. The second thing about mutual funds is that every day the fund is supposed to calculate the value of its portfolio based on the market prices of the assets it invests in. So, this is called the NAV or net asset value. So, on any given day, if you want to know the value of your holdings with mutual funds, you can just look at the NAV and know how your portfolio is doing. This leads to two benefits. You know where exactly your money is parked, and if something is going wrong with your money, you get to know about it within a day. So, there are a lot of mutual funds in India, but the major type are open-end funds. In open-end funds, you can sell part or all of your holdings in the fund on any working day of the week at the prevailing NAV. So, if you look at your fund and feel that something is going wrong with it, you get to immediately exit your investment at a transparent price that is given to you. Now, this is not a feature of many other investments. Suppose you want to sell a plot of land or a flat, it takes ages to actually get a buyer and you really do not know at what price you will get to sell it. Similarly, if you ever tried to sell a piece of gold jewelry back to your jeweler, you know that you have to take a big loss when you sell it back. If a NBFC or a bank runs into trouble, you will not know how much money you will get back until it is liquidated. Many financial products in India are not well regulated. So, you may have unregistered entities actually soliciting your money and making away with it. Sometimes your money can be going into the promoter's pocket. Now, mutual funds are subject to market risks, but they are not subject to these kinds of risks that I mentioned. Because SEBI is an extremely strict regulator, it sets a cap on the total fees that the fund can charge you for managing your money. The total fees that a mutual fund can charge you are capped by SEBI at between 1% and 2.25% of NAV. Where the funds can invest is also decided by SEBI's categorization rules. Mutual funds cannot mislabel and sell their schemes. So, if a fund calls itself a mid-cap fund, it has to invest in the 150 stocks designated as mid-cap stocks by SEBI. Therefore, though mutual funds carry market risks, they do not carry the other kinds of risks, the promoter risk, the risk of high cost, the risk of illiquidity and so on. When you as an individual investor invest in stocks or bonds, you may be able to pick the occasional good stock or good bond. But at a portfolio level, it is hard for you to make sure that the value of your portfolio does not swing too much with the markets. Mutual funds have many risk control rules that reduce the impact of the market swings on your portfolio. So, one such rule is, for example, that A mutual fund cannot invest more than 10% in a single stock or more than 25% of the portfolio in a single sector. Whenever the stock rises beyond this point, the mutual fund manager actually cuts his holdings so that it comes back within the 10% limit. Mutual fund managers may also follow other methods for risk control, like keeping some of their portfolio in cash or moving into blue chip stocks when the market looks ripe for a fall. You could try and do this at an individual level too. But the cool thing is that mutual funds do not pay tax every time they churn their portfolio. For tax purposes, mutual funds are treated as pass-through entities. So, whenever the fund manager sells stocks and makes a gain or a profit, he is not taxed for it. As an individual investor, if you do this, you will be subject to capital gains tax. Now, most people think of mutual funds as being synonymous with stock markets, but the truth is that mutual funds can be a vehicle to invest in many other assets. So, you have mutual funds that invest in different kinds of stocks, large cap, mid cap, small cap. You have mutual funds that can invest in high quality bonds or risky bonds. You have mutual funds that invest in certain sectors like IT or consumption. You have funds to invest in gold, real estate and foreign stocks. So, with such a varied menu of mutual funds at your disposal, you can actually mix and match mutual funds to meet almost any need that you can think of. So, with this, we have discussed some of the riskier investment options available to you, like mutual funds and stocks. But how do you protect what you have first? That is why you need insurance. Look forward to our next video, which will talk about all kinds of insurance that you need.